The S&P 500 is up 15% over the last year. That has been really amazing. But it's really unlikely for that to happen again this year in 2026. Normally, whenever we have three consecutive years, especially double digits years of an S&P 500, the fourth year tends to be a really negative year. We had three positive years, negative year, two positive years, negative year. For us to have four consecutive years of positive returns, it's possible, but it's really, really unusual. Now, if we look at the start of 2026, it's really an unusual start. The S&P 500 is up about 1.5%. But many of the leading stocks or the big stocks in general are not participating. Microsoft is down 5% year to date. Nvidia is not doing anything. Meta is down 6% year to date. Robinhood, which is a growth stock, it's the leader of the previous bull market and it's the leader of investor sentiment in general. Robinhood is not participating, it's down 4%. And that really tells me that there's weak leadership in general. Most of those, even AVGO is not doing much. The stocks that are really going up are highly shortage, growth stocks in general, high growth, no profits in general, and that's not really a good sign. That's kind of how 2025 started, and it started this way, and the FOMO kicked in and didn't end too well after the next few months. Now, looking at valuations, valuations are extended. We're trading at 22 times forward earnings. While valuations are not great timing indicators, I believe the market is kind of priced to perfection. If things continue the way they are and companies beat on expectations, everything is going to be fine. But if a company misses on expectations or if they deliver okay numbers, not amazing numbers, okay numbers, but not high enough to satisfy the high expectations that we have, we could have companies selling off on good earnings during the upcoming season. It has happened before, and it could happen again. And if we look at some specific companies like AVGO, is trading at 35 times forward earnings. This is one of the stocks that drove the S&P up 15% last year with a multiple expansion. Same with Google. Google last year was trading at 16 times. Now it's at 31 times earnings. It's a very different setup. Apple is at 31 times. Microsoft is still at 28 times earnings. Nvidia is at 26 times. So a lot of those stocks are kind of elevated in terms of valuations. And there's something that I've been seeing in the market, and I think it's a big misconception. And this is that if the Fed injects liquidity of $55 billion over the next 3 weeks, this is giga bullish for the market, and everything is gonna rally, and then we're gonna go to the moon. Most of the time, it kind of is in principle, like it sounds like it's bullish when the Fed injects liquidity. But we have to ask ourselves, why is the Fed injecting liquidity if everything is fine? If the Fed is injecting liquidity, maybe there's something happening, maybe there's something broken, maybe there's something wrong, or maybe there's something that's about to happen. This is a big misconception where people believe injecting liquidity is bullish. It's bullish later on, but in the near term, you have to ask yourself, why is the Fed doing this if everything is okay? Same thing with rate cuts. People believe rate cuts are bullish, but the market tends to crash a lot after the Fed cuts interest rates because the Fed is cutting rates because something bad is happening, and whatever is happening is bad for stocks in the short term. It's good for the long term, but in the short term, it tends to be bearish, and we have to ask ourselves, why is the Fed doing this? So a lot of people are not being too conservative because the Fed is going to ease, but we have to ask ourselves why. And we also have to take into consideration that maybe the Fed is not going to ease. JP Morgan is no longer expecting the Fed to cut interest rates in 2026. And he even sees a potential rate hike in 2026 because of the employment data on Friday, which has been, unemployment has been coming down. They expect unemployment to keep coming down. If that happens, then maybe the Fed is not going to be cutting interest rates. And no one is talking about this. Everyone's talking about a dovish Fed and we're going to go to the moon. But what if that doesn't happen? It's really, really bad. Looking also at the yield curve, this is a major sign that would tell you if something could potentially go wrong or not, or what's really happening in the market. And this is a 10-year yield minus 3 months. This indicator has been 100% accurate. Once it goes negative, and it reinverts to positive territory and it starts to steepen up, something bad tends to happen. We had a recession, we had a market crash in 1990. It went down and then it went up back in late 2000. We had the dot-com bust, 2000, 2001 financial crisis. Then it happened in 2006. It reinverted positive in 2007, and we had the 2008 financial crisis. Then it also kind of happened before COVID, and it went down. It's been negative for almost 2.5 years, and then it went up and it went down, and now it's starting to steepen up. So maybe that's another indicator which has been 100% accurate, that's telling us maybe something could potentially happen, maybe systematic, and that's why the Fed's injecting liquidity with us believing that everything is okay. So that's another indicator to look into. Something else that I'm looking at is the dollar. The main reason why stocks have been going up is because the dollar has fallen so much in value over the last year, but the dollar is sitting at support level. This is a key support for the dollar, and it so far held it. This kind of the same setup before 2022 in late 2021. And once the dollar found support and it started going up, it's very hard for the market to sustain such moves with the dollar potentially going up. And it looks to me like potentially the same setup here into 2026, and this is a really big one. And very recently, Trump has put in a 10% tariff, another one, and potentially 25% up to June on a lot of EU countries. So maybe the tariff war is also coming back. So there's way too many risks in the market, way too many things that could go wrong in terms of valuations, earnings not meeting the expectations, something systematic happening, something with tariffs happening, something on a geopolitical front happening, and you combine all of that with the fear and greed index. It's sitting around 62. It's almost at 75, which is where extreme greed is. It's very close to this level, and the VIX is at 15. I'm not saying anything that's kind of priced in the market as something could happen or something could go wrong. There's way too much certainty. Everyone is kind of chill. Everyone is calm. And there's a lot of FOMO, a lot of greed in general. And that makes me want to be a little bit, you could say, fearful when others are greedy. It makes me want to be a little bit more conservative and think about a lot of those risks. And this is a chart that I saw on X. To me, it's a really good chart. And it says, I don't know where we're stopping, but I know where we'll probably go back to. And this is an interesting chart that shows that every time we break to new highs, we tend to retest the previous high before the drop. That's what happened in COVID. We retested the high, and then we made new highs, and then we retested the previous high in 2025 in March, April. We retested the 2022 high, and then now we're going up. We will most likely at some point retest 6150, which was the previous high before the April of 2025 drop. To me, this is an interesting chart, and it makes a lot of sense to me. Now, I'm not trying to scare anyone. There's a lot of good things that could happen in the market. We could have another 20% year. It has happened before, and it could potentially happen again, or we could have a flat year with many stocks going up and doing really, really well, which is why I'm still mostly invested, but I'm just cautiously optimistic in general. I think there's way too many risks, and there's not enough, you could say, not enough of those risks are priced in the market. With the VIX trading at 15, it was at 14 not long ago, and there's just a lot of greed in the market. So what am I doing? I have a cash position. I don't believe in timing the market. People tell me if you have a cash position, you're timing the market. I'm just not finding a lot of value right now. There's some stocks, Meta is good value, a few others, but there's nothing really that's making me want to go all in, making me want to FOMO. If I look at the setup in general and where the fear and greed index is, where the VIX is, where the dollar is, where the yield curve is steepening up, and then all those risks in the market and the valuations, to me, I don't know. I don't want to be 100% invested. I feel like it's a good time to be having some kind of a cash position. I think that would be disciplined. So I have a cash position, and I'm monetizing the cash position through opportunistically, selling put options. Like very recently, I sold this one on SoFi, and this is like an option where I would have to buy SoFi by next month on February 20th if it gets to $19. And I would collect 1.5% interest per month, or around 18% a year annualized, just to buy SoFi at $19. Now, since then, the put is already up 50% because it was a mispricing in the market. But I've been selling a lot of those puts on SoFi and on other defensive stocks like Verizon, which could potentially go up if the market goes down, and many other stocks in general. And I'm also looking at a lot of stocks, setting price alerts, and I tend to buy a lot of great growth companies when the market goes down. Robinhood, I bought it in April at 32. It's up like 250% in a year. And I tend to find one or two of those stocks, and I set price alert. Once the price alert comes in, and I buy them, and I'm mentally prepared. I have the cash, I have my research, I have everything, and that's how I prepare for such things. I'm not trying to time the market, but if you look at history, we tend to have one of those sell-offs each year. We had one last year. We had one in 2024 due to the deep sea kind of sell-off. We had one in 2023 due to the SVB, Silicon Valley Bank. We had one in 2022 due to the Fed tightening. We had COVID in 2020. We had one in 2018. It tends to happen almost every year, and I tend to be prepared. So that's what I wanted to say. And it was not financial advice. It was just my opinion on the market. Thank you for watching. Hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.